In the context of AFM, accounting and financial management, strategy refers to the set of decisions and actions taken by financial managers and executives to achieve the organization's financial goals and objectives effectively. Here's a breakdown of the fundamentals of strategy and its importance in financial management. Fundamentals of strategy in AFM. 1. Goal orientation. Financial objectives. Strategies in AFM are designed to achieve specific financial goals, such as maximizing profitability, optimizing capital structure, ensuring liquidity, and enhancing shareholder value. Alignment with organizational goals. Strategies should be aligned with broader organizational objectives and mission to ensure coherence and unity in actions across departments and functions. 2. Decision-making framework. Data-driven analysis. Strategic decisions in AFM are based on thorough analysis of financial data, market trends, economic factors, and risk assessments. Risk management. Strategies incorporate risk management principles to identify, assess, and mitigate financial risks that could impact the organization's financial health. 3. Long-term perspective. Sustainability. Strategies in AFM focus on sustainable financial performance over the long term, rather than short-term gains. Adaptability. They should allow for adaptation to changing market conditions, technological advancements, regulatory changes, and competitive landscapes. 4. Integration with operations. Operational alignment. Financial strategies are integrated with operational activities to ensure that financial resources are allocated effectively and efficiently to support operational goals. Resource allocation. Strategies determine how financial resources, capital, funds, investments are allocated across different business units or projects to maximize returns and minimize risks. Importance of strategy in financial management. 1. Optimizing financial performance. Effective strategies in AFM help in optimizing financial performance by setting clear financial goals and aligning resources and actions to achieve them. They enable financial managers to make informed decisions regarding capital investments, financing options, cost management, and revenue generation strategies. 2. Enhancing competitiveness. Strategic financial management helps organizations gain a competitive edge by identifying and leveraging financial strengths, minimizing weaknesses, and capitalizing on market opportunities. It involves positioning the organization effectively within its industry or market segment through strategic pricing, product differentiation, and market expansion initiatives. 3. Risk management and resilience. Strategies in AFM include robust risk management practices that safeguard the organization against financial risks such as market volatility, credit defaults, liquidity crunches, and regulatory noncompliance. They ensure resilience by preparing the organization to withstand economic downturns or unexpected disruptions while maintaining financial stability. 4. Stakeholder confidence and trust. Sound financial strategies enhance transparency, accountability, and credibility in financial reporting and management practices. They build trust among stakeholders, including investors, creditors, regulators, and shareholders, thereby supporting capital-raising efforts and fostering long-term relationships. 5. Strategic resource allocation. Financial strategies guide the allocation of scarce resources, financial capital, human capital, technology investments to prioritize initiatives that contribute most effectively to achieving organizational goals. They promote efficiency in resource utilization and maximize returns on investments, thereby supporting sustainable growth and profitability. In summary, strategy in AFM is fundamental for guiding financial decision-making, optimizing performance, managing risks, and enhancing competitiveness. It ensures that financial resources are managed effectively to support organizational goals and create long-term value for stakeholders. Adopting a strategic approach to financial management is essential for navigating complexities in the business environment and achieving sustainable success. 1. Definition and importance of strategic management. Strategic management in the context of AFM, accounting and financial management, involves the formulation and implementation of key initiatives and actions taken by an organization's management to achieve its long-term goals and objectives. Here's a breakdown of its definition and importance. Definition of strategic management in AFM. Strategic management refers to the comprehensive and ongoing process of setting goals, establishing clear objectives that align with the organization's mission and vision. Analysis, conducting internal and external analysis to understand the organization's strengths, weaknesses, opportunities, and threats. SWOT analysis. Formulation, developing strategies and plans based on the analysis to achieve long-term objectives. Implementation, executing the strategies effectively throughout the organization. Evaluation, monitoring and evaluating the effectiveness of strategies and making adjustments as needed. Importance of strategic management in AFM. 1. Long-term planning. It helps organizations plan for the future by setting clear goals and determining the steps needed to achieve them. This is crucial in AFM, as financial and accounting decisions often have long-term implications. 2. Competitive advantage. Strategic management allows organizations to identify and capitalize on their strengths while addressing weaknesses, thus gaining a competitive edge in the market. 3. Resource allocation. It aids in allocating resources efficiently, ensuring that financial and accounting resources are utilized effectively to support strategic objectives. 4. Risk management. By conducting thorough analyses, strategic management helps in identifying potential risks and developing mitigation strategies, which is critical in AFM, where financial risks can significantly impact the organization. 5. Adaptability. In dynamic environments, strategic management enables organizations to adapt to changes in the market, regulations, or technology, ensuring sustainability and growth. 6. Alignment of efforts. It ensures that all departments and levels within the organization are working towards common goals, promoting unity and synergy in operations. 7. Accountability and measurement. Through evaluation and monitoring, strategic management facilitates accountability by measuring performance against set objectives, enabling continuous improvement. In AFM, strategic management is particularly important due to the discipline's focus on financial decision-making and management. It ensures that financial and accounting strategies are aligned with broader organizational strategies, fostering sustainable growth and value creation. 2 levels of strategy: corporate, business, and operational. In the context of AFM's accounting and financial management, strategies are categorized into 3 main levels: corporate, business, and operational. Each level addresses different scopes and responsibilities within an organization. Here's a breakdown of these levels. 1. Corporate strategy. Definition: corporate strategy is concerned with the overall scope and direction of an organization. It involves decisions made at the highest level of management that affect the entire organization and its long-term success. Focus in AFM. Portfolio management. Deciding which businesses or markets the organization should be involved in to maximize overall profitability and growth. Financial structure. Determining the capital structure, including decisions related to debt-equity ratio, financing options, and dividend policies. Risk management. Identifying and managing strategic risks that could impact the organization's financial health and performance. Corporate governance. Establishing frameworks and guidelines for financial reporting, compliance, and ethical standards across the organization. 2. Business strategy. Definition: business strategy focuses on how a business unit or division competes within a particular industry or market segment. It involves decisions related to how resources should be allocated to achieve competitive advantage and financial performance. Focus in AFM. Revenue generation. Setting pricing strategies, revenue models, and sales targets to maximize profitability. Cost management. Managing costs effectively to maintain competitive pricing while ensuring profitability. Market positioning. Defining the unique value proposition and competitive advantage within the market. Financial performance. Setting financial targets, budgeting, and financial forecasting for the business unit. 3. Operational strategy. Definition: operational strategy deals with the day-to-day operations and processes within an organization. It focuses on optimizing operational efficiency and effectiveness to support business and corporate strategies. Focus in AFM. Financial operations. Streamlining financial processes such as accounting, budgeting, financial reporting, and internal controls. Resource allocation. Allocating financial resources, capital, funds, investments effectively across different operational activities. Risk mitigation. Implementing controls and procedures to mitigate financial and operational risks. Performance measurement, monitoring key performance indicators, KPIs, related to financial performance, operational efficiency, and cost management. Integration and alignment, these levels of strategy are interconnected and should be aligned to ensure coherence in organizational goals and actions. Corporate strategy sets the overarching direction, business strategy defines how individual business units compete, and operational strategy ensures efficient execution of day-to-day activities to achieve strategic objectives. In AFM, understanding and effectively managing these levels of strategy are crucial for financial managers and executives to make informed decisions that drive sustainable growth, profitability, and value creation for the organization. 3. Strategic management process. Strategic management in AFM, accounting and financial management, involves a systematic approach to setting goals, making decisions, and implementing actions that optimize financial performance and contribute to organizational success. The strategic management process typically encompasses several key steps. 1. Environmental analysis. Internal analysis. Financial resources, assessing the organization's financial capabilities, including capital structure, liquidity, and financial performance metrics. Accounting systems, evaluating the effectiveness of accounting systems in providing timely and accurate financial information. Risk assessment, identifying financial risks such as market risk, credit risk, operational risk, and regulatory compliance. External analysis, market analysis, understanding market trends, customer preferences, competitive landscape, and industry dynamics that impact financial decisions. Economic factors, considering macroeconomic factors such as inflation, interest rates, and economic growth that influence financial planning. Regulatory environment, monitoring regulatory changes and compliance requirements affecting financial operations and reporting. 2. Strategy formulation, setting financial objectives. Establishing clear and measurable financial goals aligned with organizational objectives such as revenue targets, profitability margins, return on investment, ROI, and shareholder value maximization. Financial strategy development. Capital structure. Determining the optimal mix of debt and equity financing to support growth and minimize financial risk. Investment strategy. Deciding on investment priorities, capital budgeting decisions, and evaluating potential projects based on financial returns and risk assessments. Dividend policy. Formulating policies regarding the distribution of profits to shareholders, balancing between dividends and retained earnings. 3. Strategy implementation. Resource allocation. Allocating financial resources effectively across different departments and projects based on strategic priorities and financial constraints. Financial control systems. Establishing financial control mechanisms to monitor budgetary adherence, expense management, and financial performance against targets. Implementing internal controls to safeguard assets, prevent fraud, and ensure compliance with accounting standards and regulatory requirements. 4. Strategy evaluation and adjustment. Monitoring financial performance. Continuously assessing financial performance using key performance indicators, KPIs, such as financial ratios, profitability metrics, liquidity ratios, and efficiency measures. Conducting variance analysis to compare actual financial outcomes with planned targets and identifying areas for improvement or corrective actions. Strategic review. Periodically reviewing and revising financial strategies in response to changes in the internal or external environment, emerging opportunities, or threats. Incorporating feedback from financial reports, market analysis, and stakeholder expectations to refine strategic initiatives and enhance organizational agility. 5. Reporting and communication. Financial reporting. Preparing timely and accurate financial statements, including balance sheets, income statements, and cash flow statements, to provide transparency and accountability to stakeholders. Stakeholder communication. Communicating financial performance, strategy updates, and forecasts to internal stakeholders, for example management, board of directors, and external stakeholders, for example investors, creditors, regulatory authorities, to build trust and support for strategic initiatives. By following the strategic management process in AFM, organizations can effectively navigate challenges, capitalize on opportunities, and achieve sustainable financial growth and competitiveness in their respective industries. 4. Key components of strategy formulation. Strategy formulation in AFM, accounting and financial management, involves several key components that guide the process of developing effective strategies to achieve organizational goals. These components ensure alignment with financial objectives and operational capabilities. Here are the key components of strategy formulation in AFM. 1. Vision and mission statement. Vision statement defines the desired future state and long-term goals of the organization, provides a clear direction for strategic decisions in AFM, guiding financial managers towards achieving the organization's overarching objectives. Mission statement describes the purpose and core activities of the organization, guides strategic decisions by outlining the fundamental reason for the organization's existence and its role in the market. 2. Environmental analysis. Internal analysis. Financial resources, assessing the organization's financial capabilities, including capital structure, liquidity, and profitability. Accounting systems, evaluating the effectiveness of financial reporting and management information systems in supporting strategic decision-making. Risk assessment, identifying and managing financial risks such as market risk, credit risk, operational risk, and regulatory compliance. External analysis, market analysis, understanding market trends, customer preferences, competitive landscape, and industry dynamics that impact financial decisions. Economic factors, considering macroeconomic factors such as inflation, interest rates, and economic growth that influence financial planning. Regulatory environment, analyzing regulatory changes and compliance requirements affecting financial operations and reporting. 3. Setting financial objectives. Financial goals, establishing specific, measurable, achievable, relevant, and time-bound SMART financial objectives. Examples include achieving a certain level of profitability, maintaining liquidity ratios, improving return on investment, ROI, or optimizing capital structure. 4. Strategy formulation, business strategy. Revenue streams, identifying and developing strategies to maximize revenue generation through pricing strategies, sales channels, and market segmentation. Cost management, developing cost-effective strategies to enhance profitability, manage expenses, and improve operational efficiency. Market positioning, defining the organization's unique value proposition and competitive advantage in the market. Financial strategy, capital structure, determining the optimal mix of debt and equity financing to support growth and minimize financial risk. Investment strategy, deciding on investment priorities, capital budgeting decisions, and evaluating potential projects based on financial returns and risk assessments. Dividend policy, formulating policies regarding the distribution of profits to shareholders, balancing dividends and retained earnings. 5. Resource allocation, allocating financial resources effectively across different departments and projects based on strategic priorities, financial objectives, and risk considerations, ensuring alignment with the overall financial strategy and organizational goals. 6. Strategy implementation, financial control systems, establishing mechanisms to monitor and control financial performance, budget adherence, and compliance with financial policies and regulations. Internal controls, implementing internal controls to safeguard assets, prevent fraud, and ensure accurate financial reporting. 7. Risk management, financial risk assessment, identifying and assessing financial risks, including market risk, credit risk, liquidity risk, operational risk, and regulatory compliance. Risk mitigation strategies, developing strategies to mitigate identified risks and enhance resilience in financial operations. 8. Performance measurement and monitoring, key performance indicators, KPIs, defining and monitoring financial metrics and performance indicators that measure progress towards achieving strategic financial objectives. Financial reporting, ensuring timely and accurate financial reporting to stakeholders, including balance sheets, income statements, and cash flow statements. 9. Evaluation and adjustment, strategic review, Periodically reviewing and evaluating the effectiveness of financial strategies, considering changes in the internal or external environment, emerging opportunities, and threats. Adaptation, making necessary adjustments to financial strategies to optimize performance and align with evolving organizational goals and market conditions. By systematically addressing these key components during strategy formulation in AFM, organizations can develop robust financial strategies that support sustainable growth, profitability, and value creation in their respective industries.